The Morgan Report with David Morgan.
And David Morgan with you with the weekly perspective for the week ending 7 February 2020. Well, let me start with the general equity market. It's been up and down. Of course, the main issues are the coronavirus, which is very hard to get a handle on as far as what's the objective truth. I will shout out to Chris Martinson, friend, not well known, but certainly spent some time one-on-one, and appreciate all he's done and his insights, and of course his degree from Duke. I think he definitely is a straight shooter and gives probably the best information out there on the current situation. Moving on, I want to just state that anything to do with travel in the equity markets is under pressure. Airlines, obviously, cruise lines, and other transportations will be under pressure as this situation continues to unfold, and let's just wait and see what that means. So first article up that you're looking at, 5 charts show why the global economy is more vulnerable now than during the SARS epidemic. So starts off talking about the world's second largest economy, which is China. Some argue first. I'll say it second. Regardless, you can see the growth that's been almost unbelievable over the last 20 years. I mean, I was in China in the early 2000s, maybe mid-2000s, I forget exactly, probably 2006-07. And it was like the national bird was jokingly the crane, and the cranes were everywhere, and this whole area was exploding, and that was just Beijing, and of course it was all over China. Anyway, enough said. Because of that and the amount of GDP that they produce now relative to where they did 20 years ago, if they're hurting, that's going to hurt the global economy. It shows the breakdown. Agriculture, you can see, is actually still a small percentage of their GDP. Industrial, they've taken over the industrial base pretty much from the rest of the world. And then the services industry is quite large as well, as you can see from this graphic. Overseas spending by tourists really accelerated the last few years. And of course, that's starting, as you can see in the yellow line, it's the share of global expenditure starting to downtrend. And of course, travel's more or less, I wouldn't say coming to a halt, but certainly significantly impacted, especially in and out of China, because of this coronavirus situation. And then imports, and you can see it actually peaked around 2014, moved down here and for a couple of years, and basically is back up to the level. But the imports into China, exports out of China certainly could be disrupted with this situation. And then exports of goods out of China, showing this yellow line, sort of in a downtrend, has been the last few years. And with what's going on, you could expect more of the same. Next article up is from oilprice.com. Brace for a global crisis in 2020. Changes in the fundamental sociological fabric or framework of global society due to the end of the population cycle, and with it, the end of economic growth cycle based on expanding market size, were beginning to become evident at the beginning of 2020. It was apparent that 2020 was likely to see a major evolution in this transformation. The 3 inevitable trends have been promoted in recent decades: the inevitable rise of the People's Republic of China, the inevitable decline of the United States of America, and the inevitable consolidation of the European Union into a strategic superpower had all by 2020 retreated into the swamps of vainglory. Now you can read this whole article, mostly oil-oriented. Of course, oil's been hammered here of late due to less demand, and the less demand is, as I said earlier, transportation basically, and of course other factors, but that's the main one right now. I think we should still pay a great deal of attention to the oil market, and I think this is an area that could explode to the upside due to tensions worldwide and, of course, always in the Middle East, which we have our eye on. So something to pay attention, not to overlook. And actually, I'm looking for a safe, sound investment in the energy sector, probably something that I can hang my hat on, so to speak. But some of the majors reporting recently was heart-wrenching because of the amount of money that they didn't make, and these are stalwarts that are some of the biggest in the industry. But enough of that, let me move on. This is from Reuters. Qualcomm says China virus threatens phone industry disruption. Chip maker Qualcomm said on Wednesday that the coronavirus outbreak in China poses a potential threat to the mobile phone industry with possible impact on manufacturing and sales. The comments by Qualcomm, the world's biggest supplier of modem chips that connect mobile phones and other devices to wireless data networks, dragged down chip stock shares despite the signs that the industry downturn was ending. This is going to affect almost everything. I think there's no two ways about it. And of course, as I showed previously, China does a great deal of the industrial manufacturing, and of course that could change over time as people decide to move out of China and back into other areas, particularly the U.S. as an example, because of worries about what is taking place in China currently and what the future may hold. Again, from Reuters, 6 central banks to hold digital currency meeting in April. Leaders of 6 major central banks undertaking a joint research on digital currencies are considering holding their first meeting in mid-April in Washington, the Nikkei newspaper said Thursday. Bank of Japan executives said no timetable has been fixed for any meeting of the group, but said central banks must respond flexibly to rapid digitalization to stay relevant as issuers of money. Well, are they issuers of money or are they issuers of currency? And this is from CNBC, and something I didn't expect to see very often. It's there if you just have 2 eyes to see. But this, again, from CNBC, global arms trade is a nearly $200 billion business, and the U.S. drives nearly 80% of it. Well, as my friend Chris Duane likes to say, the death and debt paradigm, and certainly this article proves it out. The world spends nearly $3 trillion a year on military expenditures, and the United States drives the bulk of the globe's weapons trade, about 79%, according to figures compiled by the U.S. State Department. Sad, sad, sad. This is what the human species is up to, and it's driven by the leader of the free world. I say that as a question, not as a statement. And this week, to pick on everybody equal, this is finance and commerce, something I don't look at that often, although they have great reporting from time to time. And this is to pick on the greens. Wind turbine blades are piling up in landfills. A wind turbine's blades can be longer than a Boeing 747 wing, so at the end of their lifespan, they can't just be hauled away. First, you need to saw through it, and blah, 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 blah. These are semi-monocoque structures. I just say that because of my aircraft background. Look, these things are not doing as well as forecast, and they aren't lasting as long as forecast. And they are causing some problems in landfills. Everything that's in the green side of things, and I put green in quotation marks, isn't as green as you're led to believe. You really dig into how much energy is required, what kind of toxic chemicals, what kind of transportation or oils needed to put them into place, how much man hours and transportation it takes to get them up, how much it takes to service them, and on and on. When you really stop and think about it, there is no viable reusable energy that's reusable where you just set it up and it's done. First of all, if you could do that with solar panels, in some cases you can for quite some time, but nonetheless, how much oil, how much toxic chemicals were used to produce the product, and then, of course, to transport it and set it up. And these turbines are certainly not my first choice as a renewable source of energy. Be advised. I'm sure you can argue with me, but that's why I don't have the comment section open anymore. I don't have time to read them, and I used to. But I'll report. You can decide. All right, I'm going to finish off this article from Adam Hamilton. I'm not going to read the whole thing. I'm going to be brief on it. Before I start, I just received a letter from a member. When you are a paid member of the Morgan Report, you can ask us 2 questions per month. And this is a new investor that's new to the Morgan Report, and they actually came from Germany, not that that matters, but they had a question about the asset allocation tables in the top tier, and these spectacular gains that you see there, 800, 900, 700% from the inception, meaning when I put that investment recommendation on the list. but it hasn't done much lately. And so I did a video earlier today for the members only, pointing out that they hadn't looked very closely because year over year, every one of those stocks was up. And as I've said on other interviews, the list goes like this: up 57.5%, up 74%, up 100%, up 60%, up 43%, up 58%, and up 50%. If you average those, it was a 63% gain if you had equal amount of money in each one of those top tier recommendations. And that beat the S&P by over double. And the question was, well, these have been up since you first recommended them. Someone will recommend it in the year 2000, for example. And I went on to prove that that gold has outperformed Berkshire Hathaway over the last 2 decades, and that the well-chosen gold, silver companies have outperformed gold itself. So I assured them that they didn't look very closely, that the performance wasn't there the last year or so. It has been. Anyway, I just want to move on to this article, and I'll leave you alone. Adam says the silver mining stocks look interesting. Why they lag silver surge on gold's bull market breakout rally last summer. Their up leg still remains intact. Gold stocks' own up leg peaked in early September. So you can read this article. You can find it, I'm sure, quite easily. I think the last 2 paragraphs are the ones that I should point out and then close out. The bottom line is silver stocks' big upside potential. While their up leg last summer was truncated prematurely when gold initially peaked, the uptrend subsequently resumed. SIL defined silver relapsing again into underperforming gold, making new highs in late December. So unlike major gold stocks, major silver stocks remained in an up leg. Their up leg remains intact. This implies traders, silver stocks demand is stealthily mounting. In other words, there is pressure to the upside because of buying pressure on the silver stocks, greatly boosting the sector's upside potential. And this is the old saw. Silver is still widely undervalued relative to prevailing gold levels, not far above last summer's quarter-century plus lows. Silver has rarely been this cheap relative to gold. This is an extreme anomaly that can't last, meaning silver has far outperformed gold in its bull up legs to revert to the mean. Silver stocks will soar on that, but gold likely still faces a correction before the next up leg starts. I'll leave it at that. Wish you all the very best for this weekend. And remember, there's nothing more powerful than the truth. If you are so inclined to check out the Morgan Report on our track record versus some of the gold mutual funds out there, I would actually ask you to have a look and see how our performance stacks up against those. Again, make a great weekend. Nothing more powerful than the truth, and I will be back with you next week. Hello, I'm David Morgan, publisher of the Morgan Report, and as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources, from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter: to-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust.
Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You'll understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means my mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in the sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.